We just had some interesting data come out for the ADP non-farm employment change, and this would actually be positive number 2 for jobs data this week, and things are looking good so far this week for the story. In terms of the story, what I'm referring to is specifically the stock market story. Today's news a little bit stronger for the US dollar, not so good for metals, right? Gold down on this, which would make sense. We're seeing better than expected jobs data this week. This is strike 2 for the bears when it comes to jobs data, because if you are somebody who is saying, oh, I want the dollar to just crash through the lows and keep going big time, well, the tricky part with that is that we've had 2 data points this week that said the contrary. We had JOLTS job openings yesterday, which were better than expected, and today's ADP employment change data actually came out also better than expected. So let's break this down for just a moment. We had a forecast of 124,000 jobs created. We got 143,000. Another check mark for the labor market, and that puts us in a position to see perhaps a bit of a stronger US dollar, and also perhaps a little bit of a bounce in stocks. We'll see if that plays out, because the idea here is basically, if the labor market is confident, stocks could remain strong. And we'll come back to stocks in just a moment. Let's do the easier one first, which is taking a look at the dollar. Dollar is up off of slightly better than expected labor data, and that would cause a little bit of a push down in gold. Is this going to continue? It could, but there's also a bit of a tricky variable today and this week, that being the geopolitical situation in the Middle East, which is a big old question mark. At least me and probably 99.99% of all of us here don't know what's going to happen next in the Middle East. We are getting the headlines after everything happens. We don't know what's going to happen next. So my point with saying that is that gold is a bit of a wild card this week, because we have big headlines out of the Middle East. We don't know what the story is going to do next. If things get resolved peacefully, gold probably comes down. If things escalate or get more worrisome, gold probably goes up on that concern. Right? Remember that gold is a bit of a store of value. It's a bit of a flight to safety for many investors. And so if you're somebody who's watching gold this week, the geopolitics just put a big old question mark on the whole thing. That being said, if I'm taking a position on gold, it would be waiting for bigger pullbacks and confirmation from the edge finder. But currently, I'm not shorting this. I think selling this is incredibly difficult to do. Just like I would say trying to sell the stock market when it's in a bull market is very hard to do. Same thing with gold. When gold is in a bull market, trying to short a bull market rally for gold is just asking for trouble. So when it comes to gold, where are we at on the edge finder? Let's take a look and just filter out some readings, and you can see no sign of gold in current top setups. If we filter here for metals only, we can see gold is getting a neutral or +0 reading. That is because when we look at the economic data, there's a bit of a mixed picture. There's some things that are showing weakness, like the PMIs, but then there are other things that are not so bad, like unemployment rate wasn't so bad, right? Unemployment rate, not skyrocketing like many people had been afraid of. So right now, the main thing that I see driving gold is geopolitics, which is not something that I can predict. So that basically leaves me with nothing to do on gold. Let's move on. And again, if you're somebody who trades only one thing, the tough part about only trading one thing, like I know a lot of traders just love to trade gold, or they trade, NASDAQ only, or they trade S&P 500 only, and all of that is fine. But if you do that, you also have to accept there might be days, weeks, or possibly even months where you don't have setups because criteria is not being met. When you open up your horizons to trading more assets, the positive there is that you can usually find a lot more potential setups that still make good sense. Still looking at some of the USD crosses. I actually do have a pound dollar trade that I took yesterday, which it's slightly in the green. I like this trade still, so I bought the pound yesterday during the big sell-off with a stop loss below. We'll see how that one plays out. It was a 4-hour/daily chart level. I took a lot of trades in the VIP room yesterday. It was a very, very active trade day for me. In fact, probably the most, I said to Frank, probably the most active that I've had in the stock market. I'm sorry, in the Forex, stocks, options, everything at once day in a very long time. I took a lot of positions yesterday.
With Pulver Alerts, you get access to the complete log of all of Chris Pulver's trades. But who is Chris Pulver? Chris has over 20 years of trading experience and he's a licensed money manager. He trades all aspects of the market, including Forex, stocks, ETFs and futures, crypto, commodities, and just about everything else. Let's talk more about where you can find these trades. Inside of the A1 Trading Discord, on the left-hand side, you'll find Chris's section. It's broken up into different categories to make it easier to find the trades you're most interested in. Here, you can browse his trading journal, where he shares videos and general market analysis, his indice trades, commodity trades, Forex, stock and options, and his futures trades. All trades come with analysis, including entries and exits, risk to reward, and more. We're very excited for the future of Pulver Alerts, and we hope you are too.
Dollar index continuing higher here. Big break to the upside. But here's the question for the dollar index. Is the dollar index just heading to the top of this consolidation before a big push lower, or is it going to break out? And the answer, again, I said it in my video yesterday, 3 letters, NFP, right? If you get NFP on Friday that takes us higher, what would that look like? Well, it would look like better than expected jobs, like a lot of jobs added and unemployment rate staying steady. If you get that picture on Friday, right? If you get NFP looking real strong on Friday, then it could reverse course for the dollar big time in the short run. We don't have the forecast up in front of us, but let's just say, for example, that we get like, you know, a big uptick in jobs from where we've been. That could be incredibly bullish for the dollar. The dollar's been looking for something to rally on. It's been really beaten down. So if you get, you know, you're starting to see some good evidence for the jobs market this week. Jolt's job openings came out better than expected yesterday. Today's ADP numbers better than expected. And, you know, when it comes to going to stocks now, this is kind of what I want to see. There are two thoughts here. There are people who are more in favor of rate cuts, like they're cheering for just give us rate cuts as fast as possible. And that is the hyperfixation. And, you know, some people are even so much in that camp that they want to continue to see the labor market cooling off, weakening, so that rate cuts can come into the picture and reaccelerate the economy. There are people who are very, very much praying for rate cuts. And then there are people who are not actually praying for them, like myself and Frank. Frank and I, we had a dialogue yesterday about this on the stream. If you caught it, I thought it was a pretty good conversation. Rate cuts are usually in response to slowing economic data. As a bull in the market, I don't go to sleep at night and pray for rate cuts, because usually rate cuts fast historically are not a good thing. Rate cuts nice and slow are actually a positive thing. So the other day, we had 2 days ago, Jerome Powell spoke on Monday. This is Tuesday. Here's the Monday move, okay? On Monday's intraday price action on the S&P 500, Powell came out and said, we're not on a strict plan. to cut rates, and we may need to go slow. And the stock market did not like that, but I loved it. In fact, that was bullish to me, and I didn't buy it at that time, but that was a bullish thing to me because I want to hear that the state of the economy is pretty solid and that we don't need rate cuts. Like, rate cuts would be nice, but we don't need them immediately. We don't need prompt rate cuts to save the day. That is not what I want or what I look for in buying the stock market. One of the reasons that I'm feeling pretty bullish about the stock market overall is that if we don't need rate cuts quickly, there are going to be probably some short-term pullbacks that get generated from that. But on a longer-term basis, that brings me back to maybe this sort of story that we saw in 2023 and the first portion of 2024, which is I want to be long the NASDAQ, big tech, because those companies don't need rate cuts to continue to grow at a fast rate. Okay? So where am I most convicted in the stock market? I like the idea of being long the NASDAQ, and I like the idea of having a little bit of exposure to the Russell. So that's where I'm at. You need rate cuts to happen fast enough, not too quick, but faster, and need prices to fall so wages can catch up. Because inflation and everything went up and wages are stuck at the same spot. You're close on this answer, but I like where you're headed with this, but I think you're actually missing a part. If you have prices fall, you have a recession. Prices do not fall in a strong economy. Prices only ever fall in US history when things are bad. Because prices going up means that consumers are in a healthy enough stage to continue to bid them up. What you really want is prices to go up slower. And that's what we've seen progress on. Inflation in the United States is still positive. Inflation in the US is not, prices are not going down. And if you're waiting for prices to go down, hold your breath because you don't actually want that. In fact, if you do get prices going down in the US, most likely a lot of people probably lost their job and the economy has fallen apart. So we don't want inflation. We don't want inflation to go negative. We want inflation to just be more tolerable. Tolerable? Yeah. Now, in terms of rate cuts, we want rate cuts to happen slowly. At least that's what I want. If rate cuts happen quickly, it's usually in response to souring economic data, people losing jobs, consumers really, really struggling. They are struggling, don't get me wrong, but I'm talking about things can get much worse. So you don't want them to get much worse to trigger a bunch of rate cuts, because usually by the time they're cutting rates quickly, people are losing jobs left, right, and center. You see what I mean? So we actually want, in terms of a Goldilocks scenario, you want rates to come down gradually and prices to go up gradually.
So euro dollar is very, very similar to the pound dollar. Get rid of that. So again, in times of war, investors would generally sell the euro and buy the dollar. So generally speaking, we would more be looking to short this. And I've been saying actually that in fact, I think it was Monday, I was saying that I would more be looking to go short on euro dollar, but I need a catalyst to back that up. And I think I might have just had that. So let me just pull up some research here to show you why. Just give me a second. Here. So this is a research document that I put together every week. The reason for euro dollar short, the Eurozone is struggling with weak growth and inflation concerns, which are likely to force the ECB into further rate cuts. The USD, on the other hand, is expected to remain strong due to US economic outperformance and the Fed's rate cutting cycle, which is projected to end sooner than that of the ECB. This widening policy divergence between the Fed and the ECB makes Euro USD a solid short opportunity. So if we look on the weekly time frame as well, we've got pretty strong resistance through here. And remember, this is a weekly level of resistance, so it is something you should be paying attention to, really. We have also broken above this 200 moving average. So it's a case of, is this area that price is currently at going to be respected? Because don't get me wrong, we could definitely break above and continue up. However, if we're looking at a central bank divergence between the ECB and the Fed, we're also looking at potential war in the Middle East, which would obviously benefit the US dollar. This short position on euro dollar might be quite attractive. So I'm not ready to get into this yet, but it's definitely something that I'm interested in. Liz Truss almost crashed us, if you remember, James. Yes, I do. Liz Truss's mini budget was tragic. I think that's probably the worst attempt at being in a position of leadership I've ever seen. Boris Johnson was also quite questionable, but at least he tried. What do your entries look like? So my one on oil here, this was taken off the 15 minutes. You can see the H4 here is showing rejection to the upside off this quite nice daily level. So kind of just looking for a very basic break and retest here, looking also for the correction of the impulse move we saw yesterday when the missiles were announced. We've also got the RSI that's overbought. So, this is actually quite a low probability trade just because of the sort of market drivers behind oil at the moment. But I'm happy to take that risk. You can see I'm looking really for a 1 to 5 here, ideally. So if I can get that, then great. If not, then fine. It is what it is. Is US 30 going to fall? Maybe not. It's difficult to say. If we have war, then possibly yes. However, generally just speaking on the global macros at the moment, then more than likely not, because we have rate cuts coming, and rate cuts typically are good for stocks. So the NASDAQ, the US 30, the S&P 500, the Russell, and this is assuming that we don't have some sort of all-out war, would generally be quite bullish in my eyes. Thoughts on dollar Swiss? So I'm not in this position, by the way. Dollar Swiss, I don't have any interest in. So you can see I was looking to go short, but didn't take it. And during this period here from the end of August, so let me just move that to around here. So the end of August until the end of September, I think was meant to be a very, very bullish period. And we didn't have that. And that's because of the rate cuts. We also had a risk off market. So we had, a weaker dollar and a relatively stronger Swiss. And now we've got risk off market due to war, which again benefits the dollar and also the Swiss. So it's kind of like trying to trade two strong currencies against each other. So I've got no interest in dollar Swiss really. Greetings from Black Forest, Germany. Hello, Ben. Hope you're doing well. What's your take on New Zealand dollar? So yeah, you can see I was looking to go long here. That idea is now scrapped, obviously, because the dollar is performing quite well. It'd be interesting actually to see how far the dollar can push, because we're still stuck in a range. So I'm not yet super bullish on the dollar. But if we can start breaking out of the previous highs, excuse me, if we can start breaking out of these highs, then it might be a sign that we could start positioning ourselves for a bullish dollar, hence shorting euro dollar. In terms of the New Zealand dollar though, I'm never really a huge fan of New Zealand dollar. Technically, actually, this looks really good to go short. So just bounced off or just rejected this 200 weekly moving average. We've also rejected this sort of level here through resistance. We've got a relatively stronger dollar. So yeah, to be honest, I'm going to scrap this idea and might start looking to go short, possibly. But yeah, again, not right now, but yeah, I think shorts are on the table at some point. How long will you be in the pound Swiss trade for? That's a good question. Hopefully not long. I would quite like to get out of pound Swiss. We've just had the H4 close, so I'm going to trail my stop to break even, actually, I think. So let me just mark that up so I don't forget after the stream. So I'm going to move stops to break even. Hopefully I'll be out by tomorrow. But, you know, I'll have to just let it run. I thought Palladium was from Marvel movies. Is that what it is? Palladium? But yeah, oil looks really good going forward. Silver also looking quite healthy. So yeah, positioned very well actually at the moment. The markets could turn, but if they turn, then we're protected by silver to mitigate some risk. So the positioning I'm more than happy with. Please analyze USD JPY. So we'll go over UJ, and then I think, who have we got on after this? You got Gary on after this. So on dollar yen, Ball Out, actually, I'm not sure if he's still here, but I know Ball Out watches these shows. He actually called out this 160 or 146 level on Monday, which, you know, if he's still here, then you're almost at your target. So dollar yen is tricky. And actually, let me just read something here. One of our members put, we are not, this is from the Japan's PM, quoting, "We are not in an environment for an additional rate hike." So dovish again on the yen, hence we've had a relatively bullish period on dollar yen. So if we have war in Israel, between Iran and Israel, that's bullish for the US dollar. We've got positive ADP, which could signal relatively better NFP, which is bullish for the dollar. That might give some hope from investors for the dollar. We've also had positive jolts. So that's four things, just face value that are good for the dollar. And we've just had relatively dovish news from Japan's PM. So we've got quite a nice divergence here. The problem is we've also still got rate cuts for the Fed, and we've also likely remain flat from the Bank of Japan. So overall, I'd actually be quite bullish on the dollar yen at the moment. So we'll have to see. Again, it's not something I'm willing to trade. I won't be getting into any positions, but yeah, we'll see. Sorry, just give me a moment. I'm a bit of a slow reader. I need to catch up on this chat. Should I sell US30 now? Mask dude, no, definitely. I'm going to give you a piece of advice, and I've said this a few times, but if you're coming to a stream to ask if you should buy or sell things, you shouldn't be buying or selling anything other than demo accounts. I don't mean that in a nasty way. It's just because what if, you know, let's say Trading Extreme is down for a week and you placed a trade the week before because someone said you know, this looks good to buy or sell. You have no idea what to do. So it's never good to rely on someone, especially on stream.
Yeah, yesterday it was definitely leaning like, all right, we've got another kind of rough start to the month. You know, one thing I looked at from yesterday's price action too, and this still matters. I mean, if we go take a look at the price action from the last couple of weeks, so a lot of volatility on Monday's close, Tuesday's open. You know, we finished here yesterday, we pushed down today. I mean, are we making lower highs and lower lows? We did take out last week's low, so I would imagine that based on the probabilities I see, that this would still be a red candle for the week. So I'm still looking for the week to kind of finish red, finish choppy. If price starts to roll over and roll down, I'm looking at this potential gap fill on the FOMC. So the trades that I'm in to take advantage of that, it would be, so if we get to this gap fill, the instruments that I'm using, I am looking at a MES, so MES long put, and an MNQ long put, and I think I have a broken wing butterfly on that as well. I have an ES broken wing butterfly. So just a couple of stabs there. If that gets filled by the end of October, then there's some good profit to be had. If price falls aggressively, then my long puts with no cap, I'm going to try to take some profit on those if we end up pushing down.
So are you betting? Are you trying to collect premium until then, or are you betting on like
No, those are just hedges. Those are hedges. I'm not long. Like I'm not doing anything directionally. I think that the bigger flows are coming in like after the election, in my opinion. I think this market. So I heard some interesting stuff. Go back to 1950 to now, and anytime the market's been up over 20% in this first half of the year, October is typically a down month to the tune of like an average of like 2 to 3%. So it's like October sets up, if the market's had this great performance from like January to September, October typically offers like a dip to buy into the end of the year. That's like a 70 plus year track record. Now, there could be a little like seasonality and cherry picking to that, but it does fall in line with what we have. I mean, the market is up 20+% for the year, like 20 year to date. Go to the sectors right here, look at the S&P. We did cross year to date. I mean, we're up 19.68% year to date on the S&P. So we're right there. Like, yeah, I mean, usually the first half of the year over 10%. Market finishes higher for the rest of the year. So I still think those momentum indicators are still there. I still think the flows are still there. I just wonder if the market won't make a bigger bullish move starting October. It's going to wait until after the election, and then it's just going to keep doing its thing. So I don't know if the market has a big reaction. I mean, if Kamala Harris wins the election, the market may not have a huge reaction as opposed to like a change in leadership, I guess. If Trump is president, does that mean more tax cuts, more, I guess, deregulation? I think tariffs will be a terrible thing for the economy and for inflation, but the market might get excited on just tax structure and cuts and things like that. So I have no idea. I mean, 2016, there was a huge Trump trade. That was a wild move in the currency market, wild move in the stock market, but who knows? Like, we're sitting here near all-time highs, and I'm just following along with the structure I see. It's like, it's hard for me to be bearish outside of this would have to break for me to say, Frank, I think we have a bearish situation. But until then, I think that all we have is we have some indecision, right? A little bit of pullback, maybe to the tune of, let's say 2 to 5%, something like that. Doesn't violate this low, and then there's still room to go higher. 6,000 could be the milestone this year, and then we settle back in, some reversion. Again, one thing we could watch for is go to the 50, the 100, and the 200. Just taking some really simple moving averages. We're not crazy overextended yet, but if this keeps going higher, I'm going to look at the same thing I looked at on gold. How far away do we get from the 200 in addition to the bars? So if we have a high bar count, like 300 plus bars, and we have a distance of, let's say, 20% higher or lower, I think that reversion is very likely.
Yeah.
So anyway, that's what I'm looking for.
So the higher the divergence, the worse the correction, or the more
or just the more necessary the correction is. It doesn't have to be a nasty correction. It just means like we'll just stop going higher and start winding down. And and if it's an extreme where we get like this ballistic move to the upside and this melt up, well, then the correction is going to be a little bit more violent. I mean, if you like China, for example, it makes me a little bit nervous to see that type of move. A lot of times that type of move, when it's done, can oftentimes correct very, very violently. But if we go up and we at least base a little bit with like a bull flag, then there's at least a healthy market there to see that the order flow keeps coming in. But if we just go parabolic, I mean, that's going to end awful. Like same thing with lumber, cocoa, Bitcoin's done it in the past. Trying to think, I mean, hell, NVIDIA did it. I mean, you look at some of the semiconductor stuff, they were all parabolic and they pulled back a lot. I do have an NVIDIA hedge running as well. This one is actually so this is a good example here, Frank. Here is the 200 moving average on the daily, and we're over 400 bars. 400 bars on NVIDIA to find the 200. And at this period, let me see what that percentage was. So if I go up to the top, we were about 40% overextended from the 200 EMA. Now, there's not like some perfect rule to this, but I would say getting 40+% overextended, I think we're going to find it. And so I think NVIDIA, if not a lot happens, we're making kind of a move like this on NVIDIA. And I think this 200 EMA gets hit before NVIDIA has any chance of hitting higher highs. So I'm trading that right now. I'm looking to see if NVIDIA will come down and find this low or find this 200 EMA before I start to reposition long. So that's all.
Gotcha.
Yeah. But
I like that.
gold's decent, silver's decent. Bitcoin had a pretty nasty pullback the last couple of days. Mag 7 stuff, let's take a quick peek. Apple's down, Amazon, oh, I guess flat. They're flat. Google's down by 1% today. Meta's down 0.7, Microsoft down 0.6, Netflix is up. Go figure, I don't know. Nvidia's up 1%, Tesla down 5% today. Yikes. Any news on Tesla? Let's see.
Yeah, I wonder why.
That's a big miss. I mean, not miss, it's not an earnings play, but that's a big gap to the downside on Tesla, and I'm not really sure why.
They had delivery numbers this morning.
Is that what it is? It says will report Q3 deliveries, but I don't know if they did it yet. Maybe they did.
It says Tesla stock is down after solid delivery numbers.
Okay.
So it's up
Well, I still like Tesla. I'm just saying I want to buy it lower, a lot lower actually. So I put the trade on. Oh, I need to update my trade for. I need to update my trade for BA. I did a trade on Boeing today. That one's I'll put in my pull report section for Discord. Bond wise, things are down in bonds. Yields are up. Look at this 30-year, man. 30 years up, 20 years up, 10 years up. I think the bond market is making everybody feel foolish for jumping into this rate cut stuff. It's interesting. So we're still inverted by 13 basis points. We have dipped a little bit. I wonder if this actually heads lower. And I mean, I don't know if we're going to get inverted again, but that's one thing that would probably keep the market humming along would be getting back to an inverted yield curve. Not that anybody wants to see that, but I think that's necessary, especially with the correlation of the labor market.
Yeah, watching it drop made me wonder if this was just going to blow over soon. Let's see the T10. We're at, what, 14% now?
For what?
13% or 0.13%?
0.13 I think is the reading, so 13 basis points.
Did you know we do a live trading show Monday through Friday with guests from all over the world? To get notified when we go live, click the bell button next to the subscribe button or check in at 9:30 a.m. Eastern Time. We have helpful, free content in the description below and on our website, a1trading.com. Thanks for watching today's video, and we'll see you tomorrow.